Did Target's earnings just prove that the Fed has gone too far and they've got to hit the pause button on their rapid rate hike cycle? We'll talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. If you've owned Target stock today, you're not having a good day. This thing's down nearly 14%, and over the last year, down 41%. That's on the heels of these Q3 earnings, which came out before the bell. We'll talk about them. We'll get through these revenues. Boy, they are a complete disaster if you are a Target shareholder. But if you are looking for clues that the Federal Reserve has finally gone too far and they're going to have to put the pause button on this rate hike cycle, and my guess is you're actually going to see them reverse course sometime next year. Target's earnings absolutely prove this, and we'll look at this from a technical perspective. Let's jump into these Q3 revenues. They came in at about $26.5 billion. We'll come over here and show you them in more depth here in a moment. That was just 3.4% growth year over year. They did beat expectations by about $120 million, but right now the investors don't care about that. They care about the fact that the non-GAAP EPS number coming in at $1.54, that missed expectations by 64 cents. And you'll see this company is not doing well, at least from a quarterly financial position. Now, we also got guidance for the Q4, and here's where that evidence comes from, that the consumer is just getting beaten down by this economy. The company is expecting that a wide range of sales outcomes for the fourth quarter is possible, including low single-digit decline in comparable sales. So we're not going to have an increase in comparable sales, which Wall Street was expecting about a 3.5% increase in sales to nearly $32 billion for the upcoming quarter for Target. They're actually saying that it might be a low single-digit decline in the other direction. That is a problem. Now, the company also said that looking further ahead, Target is undertaking enterprise-wide efforts to simplify and gain efficiencies across its business with a focus on reducing complexities and lowering costs. The aim is to save $2 to $3 billion over the next 3 years. They might want to try to accelerate that, and layoffs are not expected to be a part of the efficiency push, but my guess is you will have some layoffs. So the Federal Reserve's tool is to raise interest rates. That's their tool to fight inflation. Companies and corporates, their tool to fight inflation is actually reduce complexities, lower costs, drive efficiencies in the business. That's what we're seeing across the board. So this is a good sign. There is going to be some pain in the shorter term, but this is exactly what you want in this type of environment. In the most recent quarter, revenues came in at $26.5 billion. Again, that was just 3.4% growth. The problem with that is your cost of sales went up 8%. So they're not raising prices at Target. They're also not doing this at Walmart. We covered Walmart's earnings yesterday. That stock actually went in the other direction, and I couldn't figure out why. So these companies are taking it on the chin when it comes to inflation. They're not raising prices, as prices of their goods are up 8% and their sales are up just 3.4%. They're selling general administrative, obviously the operating costs at Target, up 7.4%. So when your sales are up just 3.4% and your costs are up over 7% each, your operating income declined by nearly 50%, from $2 billion down to nearly $1.1 billion, or a shade under that. Company has a fair amount of debt. They have about $125 million of expenses there. That means your earnings before even you pay taxes is $900 million. You flow all the way down to a net income number of just $712 million. That's a 52% decline year over year on that net income. That is a just complete disaster from the earnings side. And again, we got warnings that the upcoming quarter and likely subsequent quarters at Target probably not going to be any better. Now, take a look at this. The balance sheet not looking good either. Here's our cash and cash equivalents in the most recent quarter, $954 million. Cash has left the building at Target. Look at this. They had $5.9 billion worth of cash at the beginning of the year. Last year, they had $5.7 billion worth of cash. So that cash is gone. They've got a little bit of inventory, actually a little bit. They've got a lot more inventory than they had. Obviously, in the beginning of the year, you're at the end of kind of a sales cycle when it comes to the fourth quarter and holiday season. But compared to a year ago period, they had roughly $15 billion worth of inventory. Now they got $17 billion worth of inventory, and they're expecting sales to decline. So there's going to be a lot of sales going on over at Target to move through that inventory in the coming months ahead. That is going to impact margins and obviously profitability as well. The company does have some assets like land. And so when we look at a company like this and they have such a low cash balance, there are ways if they have trouble with the liquidity, there's plenty of ways that this company can raise money. The long-term debt market probably there for them as well. Last year, they had just $11.6 billion in debt. That has ballooned all the way up to $14.2 billion, including you've got $2.2 billion worth of long-term debt that is due in the shorter term, and you have just $954 million. Things are not looking good from a financial perspective for Target. When we come down here to cash flows, believe it or not, it actually gets worse. You pull down net income of $1.9 billion. You had $5.4 billion worth of net income last year. You get to add back in non-cash charge like a depreciation. Your inventory build is here as well. And here's your cash operating target shrink to just $552 million. This is not for a quarter. We're looking at a 9-month cash flow for Target operating the business. Last year, it was $5 billion higher. This is a dramatic decline in Target's business. They are still spending on property, plant, and equipment to the tune of $4.3 billion. Last year, it was just $2.5. They took on about $1 billion in debt. They paid about $1.4 billion in dividends, and they probably made the mistake of repurchasing $2.8 billion worth of stock. They probably would rather have that cash on their balance sheet at the current time. Last year, they bought back about $5 billion worth of stock. All of this over the last 9 months, and you've bled through roughly $5 billion of cash at Target. This company is going to have to make a U-turn very quickly. They need to stop buying back the stock. They need to put this inventory that they have stacking up on sale and get rid of it, even if it's at a loss, because this company is having not necessarily a liquidity crisis, but it certainly could turn into that if we get a deep and dark recession coming to the United States, deeper and darker than I think it already is. Now, moving over to the technical segment, actually looks pretty good. Okay. Yeah, if you've held this stock for, you bought it at the top and it's down here, it's bad. But if you just look at kind of the more recent price action, you're making some higher highs. It's not like convincing, but you are convincingly making higher lows on this one. Now you're down here at the bottom. Problem is this area better hold for Target. Otherwise, you dump out the bottom. We see numerous, Meta, there's a ton of stocks that have been doing this where they kind of gap, consolidate, and then gap back down. Certainly plausible with Target looking at these financials. If you break this level, you're probably looking at a share price closer to 120, maybe even as low as around $100 per share. You rebound at this area, you should have a temporary bounce, maybe back up to the 180 region. In this range from like a price to earnings basis, not really attractive for me. Yes, you are getting a 2.4% dividend yield, but I can find companies that have a better dividend yield that don't have declining sales growth and declining earnings upcoming for the company. Cash flow has absolutely drained out of this company, and I don't expect that to come back anytime soon. The only positive is that Target's earnings prove that the Federal Reserve's plan to absolutely decimate this economy and whack inflation is absolutely going to work, and they're probably going to go overboard with it to a certain degree, and companies like this are going to feel the pain, and so are consumers. But in the end, it's creating a fantastic opportunity to accumulate stocks that are going to be able to survive this period and then come out on the other end and likely start thriving. That was Target. I would avoid single-digit margin companies like this in the shorter term. If they get beaten down enough, I think there'll be an opportunity to buy this one, but I would wait until the recovery is a little bit closer than it is today. Hopefully, you guys enjoyed today's video. Be back again later today. Good luck with your investments.